Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in there. Let's take a look, see what people are sharing, and I'll share my opinions. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these subjects, looking for potential investment opportunities that are undervalued with asymmetric, big upside potential, small downside risk. So that's what I basically dedicate my life to at this time and focus. So coming down to Trend Spider, this is TLT bonds. They want to blow to the upside, is what I see here in his tweet, and I do agree. It sure looks like it wants to go higher. Now, the question is, it's not about this breaking out of the pattern to the upside. The question you should be asking is why? Why are bonds breaking to the upside? And in my opinion, bonds are breaking to the upside because the markets are seeking safety. Well, why are they seeking safety? Well, most likely they see something in the markets like a potential slowdown or a recession or unemployment going up or all of those things combined where money is positioning in the bond market ever so more to break the downtrend line. So maybe a slowdown is coming, and you can use this as some of that evidence that you stack up against it and saying, you know what? TLT is breaking to the upside. That means something. And then what else should we look for? NASDAQ breaking down, S&P breaking down, gold's at an all-time high, unemployment rate is at 4.5%, possibly going above 5%, which is the SOM rule. There's all these things that we can look at, and in engineering, we call that the given. It's the given information that you can find in the market. Then you have to maybe use some equations, use some critical thinking to figure out, what does it mean? What does it all say? If I were to sum this all up, what is it telling me? And I just look at all the data, and what it's telling me is, there is a possibility that a slowdown is coming. And I know people want to argue that away. They're going to say, well, the unemployment number is rigged. Well, they're in there manipulating some of the interest rates. Some of this inflation data, it's just not real. It's being manipulated lower. Well, what I would say is it's all saying the same thing. It's all pointing to a slowdown. So you're taking a big leap if you're making that judgment or statement and going against what the data is saying, and just know what you're doing. Know that you are going against that data if you don't think a potential slowdown is possible here. Warren Pye says 1998 equals 2024 question mark. There are dangers in getting too focused in a single analog, but 1998 is interesting. Chart evaluations today versus the 1998 from our March report. So this is today's market is overvalued, but compared to late 1990s puts the US in 1998. 1998 was also the beginning of the commodity bull market. It was 98, 99. That's where the ratio had bottomed, turned, and went higher. The only thing that I'll say that might be a little bit different is when we did get a slowdown, and if we are getting a slowdown, the yield curve uninverted. And I think it was, oh my goodness, I think it was in 2000. And then the slowdown occurred in 2001. And I think we are getting the yield curve to kind of uninvert here. It's real close, and we'll look at it here shortly. So I kind of view this, maybe we're later. If it's in 1998, that means that we're going to still be inverted, and maybe we slowly bring down and the curve flattens. And maybe we have one last blow off top in technology stocks, and that could be the case. No one knows with 100% certainty. It's obviously seems very obvious when looking backwards. Going through it and looking forwards, it's a lot more muddy. You don't see as crystal clear as looking backwards with 2020 vision. But that's his opinion there. And here's some ratios that I'm looking at, which further muddies the waters. And I'll tell you why I think it muddies the waters. So what I have here is the oil to Dow ratio, oil to palladium, oil to silver, and oil versus uranium. And I know that seems like, oh, it's just oil versus a bunch of other commodities and a financial asset. Hold on here. These mean something. Dow, so when oil outperforms the Dow, it means that we are transitioning into a hard asset inflationary regime versus financial assets. That is what it means, not just the Dow. Oil versus palladium, palladium goes up when financial assets generally go up. It goes up when car sales are high and increasing. So that is generally a low inflation, low interest rate environment, is when palladium most of the time does well. Not all the time, but most of the time. Silver goes up during a safe haven event. So gold goes up, silver generally lags a little bit behind it and then rips. So that is our safe haven asset. And then oil versus uranium, those are similar. They go up kind of the same time, most of the time. So when looking at these ratio charts, this is crude oil versus Dow Jones Industrial Average. We've got a three-hump consolidation, a capitulation bottom in 2020, and then a break to the upside of the falling wedge. And now what do we have here? We've got another falling wedge that we're coming to the end of. Now, I don't know if we break lower like we did here in this false breakdown, like if we get a false breakdown here and then break to the upside. I don't know if it's going to do that. No one knows that. But I can tell you, if someone were to show this and you were to basically take this ratio chart and hide it, I would say, yeah, this looks like it's going to go up. And yes, we could get a small false breakdown before that occurs. I would say that no matter what it is. So that's what it looks like to me. We've got crude oil versus palladium. Now, this is a falling wedge, a capitulation bottom with the big wick. That was your buy point if you want to get the ultimate bottom. Buying that wick and then holding the entire time. And then hopefully crude oil continues to outperform palladium. We saw that in a similar situation from 2001 all the way to the peak of 2008. And it had a pretty drastic pullback in 2005-06. So I do think that could potentially happen again. Here's crude oil versus silver. I put a lower trend line with 1 touch, 2 touch, 3 touch, 4 touch, 5, 6, 7, and then 8. 8 touches is a pretty strong trend line. Then I grabbed it and put it here. 1, 2, 3, 4, 5, 6, and then we've got 7, or there's 7 here. 8, 9. There's 9 touches on this trend line. So I think they're valid trend lines. This here looks bullish to go up for crude oil versus silver. Now, here's the thing. The yield curve doesn't agree with that opinion. The yield curve doesn't, usually when the yield curve is inverted and it uninverts, if we were going to get a recession, silver should outperform crude oil. This should break down and go lower. But with me reading this, I would say, no, this looks good to go higher. Yeah, the plot thickens, muddy waters. I know. And then we've got crude oil versus uranium, and this looks good for crude oil to go up against uranium. And this is your 1 hump, 2 hump, 3 hump consolidation in your wedging type formation. And we could easily break to the upside. I can see the power being generated here. And I should say the consolidation right underneath that resistance line. So that looks good for crude oil. So coming on down, Fed funds rate and the oil price. So this is what I mean by the yield curve uninverting. I'm just using the Fed funds rate because it almost always uninverts when the Fed funds rate goes down. So I just put these here, and then if you look, After these Fed fund rate declines, oil declined some, and then it started to take off. We have one here that ran up quite a bit in 2007 and 8, and then it declined. We have this one here that was just basically no run up and just a decline, much like 2000, December of 2000. And now I think in September we could get a potential rate cut. So do you think we're going to go up or do you think we're going to go down, knowing that we've gone down two out of the three, at least from 2000, two out of the last three federal funds rate cuts? Oil has traded lower. So it's weird because you're looking at crude oil versus all these other assets and commodities. They look pretty good for crude oil to outperform. But historically, that's not what has been the case. And I would say that yields and the yield curve inverting and uninverting is a stronger macro picture than it is doing just two assets against each other for a ratio chart. So the weighting on the yield curve uninverting is you should weight that quite heavily. You can also look at the unemployment rate, and that's been going up. You want to pair that against all of the data that you know. And oil does generally pretty poorly in a recessionary environment. Here's gold and crude oil. Let's muddy the water some more. They say gold leads, but gold also moves when yields drop and a slowdown occurs in the economy, while oil generally moves lower under those conditions. What does everyone think? So what I have here is gold going up in the bars here, this red green bar chart. That's gold. The gold chart or copper looking color chart, whatever it is oil. So gold's up 50% from 2022, and oil is down 10%. Now they say that gold leads these commodity bull markets. Well, there's gold leading. It's going up 50% and oil is down 10. So does that mean that oil is going to catch up? Or does that mean that we are going to basically these alligator jaws is going to go up even more, or gold's going to outperform for even a longer period of time? But this period of time is already about 18 months plus. So, I mean, it's almost 2 years there. So are we gonna get a move higher in oil and uranium and a lot of these commodities, or are we actually going into a slowdown where gold's going to outperform, and then oil and uranium is going to underperform for a while, maybe another year or two? That I don't know. I don't think anyone knows that. Here's some more chart patterns. So this is just crude oil. And looking at crude oil priced in dollars, it looks good. Like this doesn't look bad. It's just consolidating sideways. Okay, doesn't look bad. We look at crude oil versus gold. That looks good to go higher for the crude oil to gold ratio. We've got a pattern there, falling wedge, a breakout, and then basically a consolidation into the corner here. And we're right in the corner. Haven't broken in either direction yet. Now, the 2-year yield has broken of this upward trend line. That is definitely broken to the downside, and we are gaining support where the blue line is going across. So this is very interesting. And then we've got the yield curve, the 2 and the 10-year yield curve. It's right at about 1%. It means the yield curve is flattening. The 2-year equals the 10-year. That's what the 1.0 means. So with this yield curve uninverts, a slowdown is most likely coming. 2-year yields front run the Fed funds. But I'm pretty sure the Fed funds is going to lower rates here soon. And that generally coincides with a potential slowdown. Tavi says, one thing I've learned in this business is to always pay attention to the messages the bond market is conveying. Each time we've observed the current level of rate cuts reflected in bond prices, a recession has followed. The steepening yield curve also points to a likely economic downturn. Meanwhile, equity markets remain stubbornly overvalued and with multiples priced in for perfection and largely reflecting what appears to be an unrealistic macro environment. This is markets are again pricing more Fed cuts in the next 12 months. So when it's negative, this is Fed cuts, this is Fed raising rates. And then the recessions at when the Fed cuts rates before it. Container shipping costs from China have spiked to their highest levels since 2022. So this is container shipping costs from China have spiked to their highest level. Since the beginning of 2024, shipping rates have more than tripled. It now costs $9,000 to ship a 40-foot container from Shanghai to New York and $8,000 to Los Angeles. This has been driven by sharp drop in Suez Canal transit volume, disruptions at some ports in Asia, and demand increase due to inventory restocking. Rising shipping costs are fueling inflation. Does this correlate with a slowdown? Is a recession coming and we're seeing container shipping rates go up? That doesn't make sense. Or are we coming out of a recession? Yeah, the data is weird, guys. Not everything is in alignment. We've got all these data scattered across. The US dollar's next move may well decide the short term fate for gold and oil and many other markets. So, this is the US dollar index, gold and oil. So, what he's talking about here is we've got this move higher here in this resistance support level. And it's starting to break below that support level, starting to break down. And whenever we've seen the dollar index break out of these patterns to the upside, gold and oil has plunged. And when they break to the downside and go lower, that is where gold and oil take off. So when you price gold and oil and commodities in dollars and the dollar goes down, which is the denominator, you see the pricing of those commodities go up because of the weakness in the dollar. So you want to look at the DXY. You want to see when it breaks upward and you want to see when it goes downward. And right now we could break to the downside, which means gold and oil could take off because the denominator is going down, and it just muddies the waters even further because there's some evidence that we get that crude oil could do very well. And there's other evidence stating that a recession or a slowdown could come and could negatively impact oil. Two sides to all these coins, guys. Here's another one from Andreas. SAR West's old model is rock solid, but 5% is not the end of the world. Would be a pretty soft outcome in case. So unemployment trend consistent with recession and should continue to rise. This is unemployment. And that follows the SAR-WE labor market condition index, which leads by 5 months and has already gone up. So the key takeaway here is most likely unemployment, USA unemployment rate will go up probably to 5%, depending on where the dark blue line continues to go. And the leftover DUCs, that's drilled uncompleted wells, are mainly dry, uneconomical wells, which won't get fracked at all. This is a hard cap on the U.S. shale oil production growth. And our oil DUC rate, I mean, it is just way down there compared to previous 2020 levels. We're down there quite a bit, and we're continuing to eat through the DUC inventory, drilled uncompleted wells. Eventually, this will bottom here, and we will be out of that inventory. Here is the number of Bloomberg news articles containing the word oil, 2015 to now, and you can see we are way down there for a bottom, perhaps. We are way down there. 2020 was pretty low, too, in some areas. Clients can read the whole report here. This is stocks to crash 30% as U.S. enters recession next year, BCA research says. The events of the past few weeks should give investors a taste of what's to come, in their opinion. What they have here is These first emerged in Europe and China and then spread to the US following a surprise jump in the unemployment rate. What they're talking about. Top-down charts. Seasonally speaking, now is the time for weaker US dollar and stronger crude oil price. So the US dollar index, I think he's got that backwards. The US dollar index bottoms. Oh, yeah, no, he's got it right for short period, August, September, October. We still have August, September, October of higher crude oil prices. And we do see weaker US dollar from August, September, and October. And then conversely, it bottoms. And then we see weak or stronger dollar and weaker crude oil prices towards the end of the year, seasonally. Cross-border capital, world GDP is softening, but not yet stalling. Latest daily nowcast. So it's softening. We've been coming down, but it hasn't stopped yet. The music hasn't stopped. And if you guys know the movie that's from, put it in the comments section about that he doesn't hear any music. Wyatt. Can we expect a significant drop in oil when the yield curve uninverts? And we've got these uninversion of the yield curves. You can see minus 18%, minus 41, minus 52, and minus 65. Now, the one that I think it most mimics is 2000. It's this one here, 41%. But that's from top to bottom. What are we at right now? I mean, that went from 120, I think, down to what, 80? So we're already 40 off the peak. So it would be 40 divided by 120. So we are already off the top by 33%. So I don't know how much farther we have to drop from top to bottom and then from this top to bottom. Curious to see what occurs here. And that's what we've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We still have the May Day coupon code that's still active if you're interested in joining. This is Sunday. We have a 5 p.m. question and answer session today. If you want to answer or ask, if you want to ask any questions, go ahead and show up to the Q&A meeting. Ask me whatever you want, and I'll try to answer it the best I can. And if I don't know it, I'll let you know, and I'll do some research into it. But that's what I've got for today, and we'll catch you next time. This is Finding Value.